When you pull a dollar bill out of your wallet, it feels like the definitive unit of the American economy. But physical paper currency actually makes up a tiny, almost negligible fraction of the money circulating right now. The United States money supply sits at an all-time high of $22.6 trillion. Most of that simply exists as numbers in a checking account or digits on a screen. The common assumption about how those numbers get there goes like this. You walk into your local branch and deposit $1,000. The bank takes your cash, locks it safely away, and waits for someone else to borrow that exact same stack of bills. It sounds clean, simple, and entirely logical. It is also completely wrong. The vast majority of the money in existence today was not printed by the government. It was created out of thin air by private commercial banks. To see exactly how they pull this off, we have to look closely at a single transaction. Let us say you deposit $1,000 into your personal account. Your bank operates under a system called fractional reserve banking. This means they are only required to hold on to a small fraction of your deposit, historically around 10%. So they keep $100 in reserve and section off the remaining $900. But the bank does not take your $900 out of a physical vault and hand it to a borrower. Instead, they open a new account for someone else and simply type $900 onto their screen. They create that loan digitally from nothing. Your account still shows your full $1,000 balance. You can spend it right now. But the new borrower also has an entirely separate $900 to spend. The system suddenly has $1,900 in it. Your original deposit was never the physical source of the loan. It was simply the legal permission slip the bank needed to artificially expand the money supply. Now, watch what happens when that new money starts moving. The borrower takes $900 and buys a scooter. The seller takes that cash and deposits it into another bank. The second bank treats that $900 exactly like a fresh deposit. They hold 10%, $90, in reserve, and type another $810 into existence for their next borrower. That borrower buys goods. The merchant deposits the $810 into a third bank, which holds $81 and creates a fresh $729 loan. This cycle of deposits spawning new loans ripples continuously across the entire financial system. By the time that sequence fully exhausts itself, the original $1,000 you dropped off at your local branch has grown. The banking sector has manufactured up to $10,000 in total circulating currency. Economists call this mechanism the money multiplier. Every single real dollar introduced into the system gives banks the theoretical capacity to generate 10 digital dollars in the broader economy. Right now, as we speak, that precise multiplication sequence is running millions of times a day across thousands of commercial banks. This chart tracks the exact result of that compounding process. It shows the U.S. M2 money supply, starting at $286 billion when records began in 1959. Driven by that multiplying effect, the line arcs upward, charting a 78 times growth curve that hits $22.6 trillion by 2026. That mountain of $22.6 trillion did not roll off a federal printing press. The overwhelming majority of it was aggressively generated by commercial banks executing those exact fractional loans. When you log into your account, you are looking at the structural foundation of the entire system. Your deposit is the mathematical anchor that allows lenders to inflate the economy. Understanding how banks synthesizes currency gives you the necessary context to navigate what happens next. It explains the mechanics of runaway inflation, clarifies why credit markets crashed so violently in 2008, and dictates how you must protect your own assets when that invisible arithmetic finally breaks down. If you've looked at your rent or your grocery receipt lately, you already know the math is working against you. A dollar today simply doesn't stretch as far as it did 10 years ago. Filling a standard shopping cart with basics like eggs and butter has become a source of genuine financial stress for millions of families. Logistics and corporate policies affect individual price tags, yet a mathematical link exists between the total volume of currency in circulation and the cost of everything you buy. The erosion of your purchasing power is tied to the process of money creation, where commercial banks generate new dollars through the act of lending. To figure out how to protect the value of your labor, you have to understand the mechanics behind a 350-year-old banking practice. The system we use today started in 17th century London. Wealthy merchants needed a secure place to store their physical gold, so they deposited it inside the heavy vaults of local goldsmiths in exchange for paper receipts. Those paper receipts eventually started trading as currency. The goldsmiths soon noticed that their depositors almost never came back to withdraw all their physical gold at the exact same time. The vault owners saw an opportunity to profit. They began issuing extra paper receipts and lending them out, handing out claims for gold that did not exist. They charged interest on these unbacked loans. As long as the depositors didn't all demand their gold on the exact same day, the illusion held, and the goldsmiths collected a profit on money they created from nothing. This practice became the blueprint for fractional reserve banking, a system that functions on the assumption that only a small percentage of depositors will ever want their money back at once. Over the next 3 centuries, major commercial banks replaced those early goldsmiths. Digital digits and paper bills replaced the physical gold, yet the underlying mathematics remain the same. Today's banks still create money by lending out far more than they actually hold in reserve. To stabilize this fragile structure, the United States established the Federal Reserve in 1913. The Fed acts as the ultimate safety net, stepping in as the lender of last resort if a sudden panic leads to a bank run. Because this government backstop exists, commercial banks have the confidence to push the money creation engine to its limits, setting the stage for major economic shifts when the system runs too hot. In basic economic logic, inflation occurs when the money supply grows faster than the production of goods. If an economy has 100 apples and $100, each apple costs $1. If banks create another $100 and there are still only 100 apples, the price adjusts to $2. Between 2020 and 2022, the Federal Reserve dropped bank reserve requirements to 0. This allowed commercial banks to create loans and expand the money supply more freely than at any other point in modern history. At the same time, the government injected trillions of dollars in stimulus relief directly into the economy. The result? In January 2020, the M2 money supply was $15.4 trillion. By March 2022, it exploded to $21.7 trillion, a $6 trillion increase. As the bottom row illustrates, consumer price inflation reached a peak of 9.1% shortly after. Economists debate the exact influence of energy prices and labor shortages during this period. However, the data reflects a consistent pattern seen throughout financial history. When the supply of money expands far faster than the production of goods, the purchasing power of each dollar tends to fall. The second point of failure is the total system seizure. Fractional reserve banking functions on confidence, and that confidence vanishes if everyone tries to withdraw their money at once. Leading up to 2008, banks used their money creation power to fund risky subprime mortgages, lending to homebuyers who had little chance of repaying the loans. When housing prices began to fall, those loans went bad. The complex financial products built on top of them became toxic, threatening the solvency of the world's largest banks. In September 2008, Lehman Brothers filed for bankruptcy. Panic rippled through the financial sector. Banks stopped lending to one another, and the global credit markets froze. This data captures the rescue effort. The Federal Reserve expanded its balance sheet by $4.5 trillion to buy bad assets. But the cost was immense: 8.7 million lost jobs and the destruction of $10 trillion in household wealth. Behind these technical statistics were millions of individuals whose lives were upended by a collapse they did not cause. The fractional reserve system provides the liquidity that powers our daily lives. But when banks create money recklessly, the system breaks, and it is always the ordinary citizen who pays the ultimate price.
Picture your last paycheck hitting your account. The notification pops up on your phone, and your available balance goes up. But where is that physical money sitting right now? If you are imagining a thick steel vault stacking paper bills with your name on them, you are picturing an outdated world. A modern bank account is not a secure storage box. This visualization shows the U.S. banking system's total balance sheet as of March 2026. At $25 trillion, it is almost the entire annual U.S. economic output. Inside that system, $22.6 trillion represents the M2 money supply, the actual money banks have created. Banks treat your deposits as mathematical permission to create brand new money out of thin air by issuing loans. Operating under the illusion that your bank is just a digital vault leaves you blind to the actual engine moving the modern economy. We know what happens when reckless money creation goes unchecked. The financial system collapses, and ordinary people pay the price. Following the 2008 crash, Congress passed the Dodd-Frank Act. Banks were forced to undergo rigorous stress tests and curb their riskiest bets to build a safer operational framework. This shows bank regulation today. Left, capital requirements, their own money held against losses. Right, reserve requirements, customer deposits kept in the vault. But in March 2020, the Fed eliminated reserve requirements completely, dropping that mandated fraction to zero. The banking sector is better capitalized now than it was 2 decades ago. But technically, your bank has exactly zero obligation to hold a minimum fraction of your specific deposit in reserve. The underlying engine driving all of this is a 300-year-old profit incentive. Banks generate revenue by issuing loans. Every time someone signs a mortgage or a car lease, the bank creates that new money. The more loans they issue, the more money enters the economy, and the bank collects the resulting interest as pure profit. This chart shows the expanding M2 money supply mapped directly against the value of a single dollar bill. When money enters the economy faster than goods and services, prices inevitably rise. That dynamic is driving our current 2026 inflation rate of 2.7%. The very mechanism that fuels the economy's lending ensures that any cash you leave sitting idle will slowly, mathematically lose its purchasing power. Now that you see how the board is set, you can start making strategic moves to protect your own capital. Action 1 is to starve your checking account. Only keep your operating cash there to cover rent, bills, and groceries. Anything extra left in a standard account is simply you lending your money to the bank for free. Action 2, build a high-yield defense. Checking accounts stagnate at zero, while institutions like Ally pay 5% APY. Action 3, inflation is a tax. Subtracting 2.7% inflation drops standard accounts negative. Only high-yield accounts keep purchasing power positive. But to truly outpace this hidden tax over a lifetime, you have to move beyond savings and acquire assets that actually appreciate, like equities or real estate. By managing your cash flow strictly and demanding a yield on your deposits, you cut off the free subsidy to the bank's lending engine and start actively defending your own wealth. Action 4 is to weaponize debt intentionally. Taking out a loan means you are participating in their money creation process, and your legal promise to repay becomes their guaranteed profit stream. So apply a strict rule. Only use bank debt to acquire assets that will increase in value. Avoid financing depreciating goods like clothes or cars, where the bank gets rich off your consumption. Action 5 is to ride the systemic wave itself. The best way to do this is by investing consistently in broad market index funds. When banks pump new money into the economy and general prices go up, corporate revenues and profit margins tend to rise right along with them. Owning shares in an index like VTI or VOO means you capture a piece of that systemic growth. The modern banking mechanism is a 300-year-old tool for allocating capital across the economy. Understanding this system makes you financially literate. If this changed your perspective, drop a comment below and let me know if you knew banks created money before watching. And hit subscribe, because next week we are exposing exactly how credit cards are engineered to keep you paying forever.
I hope you liked this video. Don't forget to like and subscribe.